Welcome to the Stock Market Palantir. Today we are going to talk about EVEX. Eve Holding Inc., or EVEX, it's arguably one of the most compelling yet also contentious players in the electric vertical takeoff and landing, the eVTOL sector. It's a crucial case study because you have this pre-revenue deep tech firm that also benefits from this huge industrial advantage of being a spin-off from Embraer.
That industrial lineage certainly matters, I agree. It grants them instant credibility. But we have to remember this company is still very much a startup. It operates in an extremely high-risk, high-reward sector. And it's facing immense operational costs and, cash burn until they actually deliver an aircraft.
Precisely. And that brings us to the core question we really need to get into today, looking specifically at the dramatic stock activity we saw in late 2025. Was the significant bullish price appreciation, especially that spike we saw in early December, was it fundamentally driven by strategic operational milestones and, long-term industrial validation, or was it primarily a function of necessary capital management and just technical market structure volatility?
Well, I'm going to argue that while the partnerships and the headlines look promising, the stock's pronounced volatility and its recent price movements are overwhelmingly defined by its aggressive cash burn, the inherent risk of future dilution, and a highly speculative market structure. Look, the price action is being driven by volatility traders and momentum triggers, not purely fundamental conviction.
And I'm going to argue the opposite. I believe the recent price strength is fundamentally justified. The moves EVEX made in the back half of 2025 were strategic de-risking actions that validate the company as a mature contender. They are leveraging their legacy industrial strength to accelerate certification and, crucially, to proactively manage their capital needs. So my position rests on the belief that Eve Holding has substantially de-risked its path to market, and institutions are recognizing and reacting to that shift. The major catalyst, in my view, was the December 2nd, 2025 announcement that EVEX had selected Beta Technologies to supply its electric pusher motors.
Okay, so sourcing specialized components, that's often a smart move.
It's more than smart. It's a highly pragmatic buy versus build decision in a sector this capital intensive. Eve is essentially outsourcing the technology development risk here. By sourcing complex, high-demand components like electric motors from a firm like Beta, which has already validated this exact technology through thousands of flight hours in their own programs, Eve drastically accelerates their own certification timeline. This move is all about reducing CapEx and technical uncertainty.
That reduction in R&D risk is tangible, I'll grant you that. But the financial scale of the commitment, that raises other questions.
But the scale is actually the validation point. This agreement, it represents a potential opportunity worth up to $1 billion for Beta over the next decade. This commitment serves as what I'd call a billion-dollar signal. It validates Eve's enormous backlog.
100 aircraft letters of intent, or LOIs. And for listeners who may not be familiar with the jargon, LOIs are basically non-binding commercial expressions of interest. They're paper orders, not firm, deposit-backed commitments.
Exactly. But when industrial partners like Beta commit up to $1 billion in supply chain infrastructure based on those LOIs, it means they view the demand as credible. The likelihood of those orders converting to revenue seems high to them. It moves the backlog out of the realm of soft orders and closer to hard reality. And on top of that, we have to talk about the $230 million equity raise in August. This wasn't a panic move. It was a proactive decision that extended the company's cash runway through the 2027 entry into service target. And critically, the involvement of BNDES, that's Brazil's National Development Bank, in that funding round implies a high level of sovereign support. This provides a kind of implicit safety net, structurally raising the floor of the equity in a way that, frankly, pure-play U.S. competitors just don't have.
I see why you're emphasizing that industrial and governmental support, but let me give you a different perspective on that cash runway. While strategic partnerships are positive for the eventual product, the stock's recent volatility is, I believe, fundamentally defined by tight financial pressure. We have to look at the Q3 2025 results that came out in November.
Which showed an acceleration of spending, yes.
A significant acceleration. The net operational loss widened to $47 million, driven by R&D expenses ballooning to nearly $45 million in a single quarter. I mean, if you project that out, it translates to an annualized operational cash burn trajectory of somewhere between $200 and $250 million. Now compare that back to the $230 million they raised in August. That raise only buys them time through 2027. For a company in the middle of a complex certification program, that runway is extremely tight.
But they successfully locked in the capital they needed for the current program timeline.
They did, but that capital is only sufficient if they hit every single milestone perfectly without the inevitable setbacks that are so common in aerospace development. This pressure, you can see it reflected in the market structure itself. We see data indicating that anywhere from 38% to nearly 70% of EVEX daily trading volume happens off-exchange in dark pools. That exceptionally high internalization rate, which peaked near 70% in mid-November, is a strong signal to me that market makers and quantitative traders are treating EVEX as a high beta volatility instrument, running sophisticated option strategies, not just as a standard long-term equity investment. The price action that results is highly technical.
Okay, let's pivot back to that integration strategy, because it directly impacts your concern about the 2027 runway. I believe the industrial systems integrator approach is precisely what saves the company from needing more capital earlier.
How so?
By assembling best-in-class components, like the electric motors from Beta, avionics from Garmin, controls from Honeywell, Eve is consciously reducing the enormous capital expenditures and R&D risks that's inherent in designing every core system internally. You just have to contrast this with the vertically integrated models that peers like Joby Aviation favor, which requires massive upfront investment in facilities and internal R&D. Eve is outsourcing that complex manufacturing and validation risk to proven Tier 1 aerospace suppliers. And on top of that, their commercial success is broadening. That Bahrain framework agreement they announced in November, it covers the Middle East and North Africa. It just reinforces Eve's positioning as the essential global eVTOL player with commercial reach where some of their US-centric competitors are lagging.
That's a compelling argument on the CapEx savings, I'll give you that. But have you fully accounted for the downside, which is integration risk? Getting disparate, complex systems from different vendors to communicate and work seamlessly together is arguably the hardest part of modern aircraft development. It's not just about bolting parts together, it's about integrating the flight control software.
Right, but Embraer's pedigree is in integrating systems. That's what they do best.
Embraer's pedigree is in integrating systems they largely control, or systems that conform to very established aviation standards. Software integration, especially when you're dealing with the novel technology required for eVTOL flight control, it's just different when those components come from three separate, fiercely independent suppliers. A software glitch or a communication failure between, say, the Beta motor controller and the Garmin flight deck could cause delays just as significant as a physical design flaw.
But that risk has to be priced into the timeline.
Perhaps, but the 2027 Entry into Service, or EIS timeline, already puts Eve behind some competitors who are aiming for 2025 or 2026. If certification slips beyond 2027, which, let's be honest, is a common and often predictable thing in revolutionary aerospace development, the financial benefits of that outsourced supply chain, they just vanish, because the clock starts ticking on cash burn again. Any significant slip, even 6 months, translates into an immediate need for further equity raises regardless of that $230 million buffer. That's why the stock is so vulnerable to news about the timeline.
I accept that aerospace timelines can be fluid, but the industrial foundation here significantly mitigates the risk of a total collapse, which is where a lot of pure startups struggle. Let's pivot, though, to the market structure you raised, the high dark pool participation, because I think the narrative around it is, well, it's often misinterpreted.
And how do you interpret it? I see that high off-exchange volume as confirmation that large institutions are actively managing their exposure and hedging against near-term volatility, often in ways that precede sharp technical moves. We've seen data showing market makers like Citadel sharply reducing their long-dated call options while, at the same time, increasing their puts by well over 200%.
That's managing risk, not necessarily bearish manipulation.
It is managing risk, but it reveals the conviction level. The high rate of market maker internalization, which is really just them filling retail orders off exchange instead of routing them to the NYSE,
It allows these large players to quietly accumulate or hedge without dramatically moving the public price. But what happens when a key technical level is breached? Like when the stock crossed its 200-day moving average, which was sitting around 460. That rapid movement we saw was likely driven by quantitative momentum triggers kicking in after the market makers completed their process, causing a burst of activity divorced from fundamental news.
See, I'm not convinced by that line of reasoning. High dark pool volume in a low-float security like EVEX is actually a structural necessity for maintaining liquidity. If institutions were forced to execute massive blocks of stock on the public exchange, the volatility and the slippage would be severe, driving the price down dramatically just because of the trade size. These pools are the mechanism that prevents dramatic, destabilizing price swings during these large institutional trades.
Preventing downward movement, perhaps.
And upward movement. It ensures price discovery remains relatively orderly. More importantly, we see strategic accumulation occurring through these pools, which contradicts the idea that it's only speculative hedging happening. Look at major banks like Goldman Sachs. They increased their position by over 500% in the last filing cycle. That accumulation aligns directly with their public neutral rating and a price target of around $4.84. So sophisticated capital is clearly building strategic long positions through these mechanisms. They aren't just selling volatility.
That is an interesting distinction, especially the evidence of accumulation alongside all the hedging.
And what's more, we need to address the common retail theories tied to dark pool trading. The FTD data, the failure to deliver data, is negligible. It's less than 0.1% relative to the float. This fundamentally debunks the often cited speculation that this high dark pool activity is driven by widespread naked shorting. It's primarily driven by efficient liquidity provision for sophisticated capital.
That is a crucial point on the FTD data. And I agree, the manipulation narratives often miss the operational realities of market makers. However, that accumulation still speaks to the high beta, high risk nature of the stock, not the imminent conversion of those LOIs into revenue. And speaking of shareholder anxiety, we need to address the persistent confusion about the capital structure that keeps cropping up.
Absolutely. We need to clearly and concisely clarify this. I'm talking about the fear of a reverse stock split. I can state definitively, Eve Holding has not executed a reverse stock split since its May 2022 listing.
So where does that confusion come from then?
It stems from the original SPAC unit separation, the ZNTEU units splitting into EVX stock and EVXW warrants, and just sector contagion. A lot of distressed SPACs have had to enact reverse splits to stay listed. EVX trades well above the NYSE minimum. The stability offered by the Embraer lineage, and critically, the BNDES involvement, provides a structural safety net, a demonstrably higher floor that gives shareholders assurance against total failure, even if dilution remains a risk.
Okay, while I accept that no reverse split has happened, the mere existence of that confusion reflects the broader market's nervousness about the SPAC sector in general and the ongoing absolute need for capital in this deep tech field. Your point about liquidity lasting only through 2027 is precisely the issue. That timeline guarantees significant dilution risk, and the operational uncertainty around the next major milestone is a major binary event that will resolve all of this.
And that milestone is the first flight of the conforming prototype, expected late 2025 or early 2026.
Correct. This is the first model built exactly as the production version will be, using all those sourced, integrated components. If that timeline slips, even slightly, the discussion immediately reverts to the need for fresh capital and the dilution that comes with it. This stock is fundamentally speculative until that conforming flight is successful and they prove those disparate systems, the motors, the avionics, the software, can integrate seamlessly and reliably.
So ultimately, EVX offers investors a highly leveraged bet on the eventual industrialization of urban air mobility. This position is, I argue, substantially de-risked compared to its peers by concrete strategic partnerships, most recently that crucial beta deal and the high industrial floor provided by the backing of Embraer and the Brazilian state.
And I maintain that this remains a high beta, pre-revenue stock where structural market forces, particularly market maker internalization driving momentum, and that extremely tight 2027 cash runway create substantial execution risk and volatility that warrants caution. The stock's recent appreciation was driven by the liquidity injection and technical momentum just as much as it was by strategic news.
We both agree, however, that the next major catalyst, the success or failure of the conforming prototype's first flight, is going to be the determinant factor. That event will dictate whether that $14.5 billion paper backlog converts into a tangible, revenue-generating aerospace franchise, or if the company has to return to the market for significant new funding.
The path forward is binary, and the market structure guarantees the ride will remain volatile until that core engineering risk is fully retired.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.